If it wasn't for the reduction in the prices of technological goods, the actual low income inflation much higher. But prices of things like computers, phones, and other stuff keeps going down. And the way the indexes are calculated, you know, they affect it. Similarly with cars. And by the way, just to see the I don't know, US 10-year. Look at the real yield on the 10-year. It's not 1.5, it's 2. If you looked at the 30 years, it's going to be about 2.5. That's what I'm talking about. Even on the real side, there's a risk premium involved, right? Why? Because who knows what's going to happen in 30 years? Ask the British. Ask the British in 1930s as a nation versus ask the British now. They are no longer an empire. It's not just about being an empire. Technically speaking, they're not even considered an important superpower. And outside of London, when you talk to English people, you see that. That's, for example, how the South feels right now. Think about the South antebellum versus the South now. Whatever you think of the Civil War, South was a, economically speaking, proud place, right? But not anymore. They actually feel, it's not that America anymore. That's how the British feel because they're no longer powerful. So who knows? I mean, yes, if China was actually managed as a democracy, they already would have been the biggest economic power. They're still so big despite being managed economically so badly. And in 50 years, US is not going to be the major power in the world. Whether you like that or not is besides the point. It's a reality. That's what happens to empires. Even Roman Empire, which pretty much dominated everything, right? The actual empire lasted maybe 300 years. That's it. From the days of Augustus until the Constantine. That's it. I mean, they even let the lowly Christians pretty much take over the entire Rome. Think about it. So something's going to happen. That's why if I'm going to buy a 30-year nominal or real bond, I'm going to ask for extra compensation. And when uncertainty increases, those compensations are going to increase even more. I mean, there is a chance that we were going to have a good housing market this spring and summer. If this thing continues, you can forget about that. That's it, done. How big is the recession going to be? I have no idea because we don't know the extent of the damage yet. We don't know how stubborn they're going to be. Let me show you another example since we're doing this anyway. This is always a good idea to look at. Federal Reserve has a database called FRED. It's called Federal Reserve Economic Database. It's kept by St. Louis Fed. I'm just going to show you what happened to the spreads on relatively low quality bonds over the last month or so. On the business side, the driver of the growth is almost always small and medium caps. Why? Because those guys have a lot more room to grow. You cannot grow Apple 50% unless they come up with a new revolutionary stuff. The only thing that grows 50% these days is NVIDIA. Because why? Over the last 3 years, they came up with something very revolutionary. But that thing is going to come down too, eventually. But NVIDIA, that was a lot of it supplying from small or medium caps. Now, those guys have to finance themselves. So let's look at uh, single B option adjusted spread. A single B bond is a bond that is still considered a junk bond, but it's not that crappy either. Typically, expected default over a 3-year period is about 20%, but there's always a recovery ratio. So if I'm holder of one of these, I should not expect more than losing 5% of my investment at most. Okay, they're risky, but they're not that risky. And currently, the spread over the corresponding treasuries is 3.5, which is historically rather low. Let's actually look at this over the last 4 months or so, since a little bit before election. This is right after the election. These were single B spreads. Single B spreads trading at 2.5 is very, very low. Now it's 1% above. There is at least $1 trillion worth of these kinds of bonds out there. Now you added 1% a year to the cost of these things. 1% of 1 trillion is $10 billion. Now, if I'm a small company and I was thinking about expanding my business, I cannot afford that cost anymore, which means I'm going to hold up. And this is only the beginning. And we haven't seen the full effect on that yet. I mean, just from beginning of February to now, the difference is 75% basis points. This is the only single Bs we have, the double Bs, triple Bs. Even there, let's look at triple B, the lowest investment grade you can get. It was less than a point or percent. Now it's $1.17. You're thinking, yeah, it's only 20 basis points. Yes, but for now it's only 20 basis points. When things start going to craps, let me show you what happened to this during COVID years. I mean, remember, this is investment grade. Spreads were 5%. If this thing keeps escalating, we're going to have spreads of at least 3% in investment grade bonds. And investment grade bonds trading at 3% spread, I can guarantee you there's going to be at least 3% a year reduction in GDP. You can look at it historically. They're very highly correlated. And people are going to, even if they're not necessarily concerned, there is flight to safety. They're going to dump these and they're going to buy short-term treasuries. That's it. Or they're going to buy short-term tips because they also want to be protected against inflation. And U.S. government is going to lose. They think they're getting tariffs, but they're going to lose a lot of tax income from income taxes, corporate taxes. Corporations do not pay too much federal anyway because they can arbitrage international tax laws. Do you really think that Apple is going to start paying any U.S. taxes? No. They pay zero U.S. federal taxes, by the way. They do pay state. That's about it. And this is going to continue. Let me show you one more thing about reading tea leaves. Next Wednesday, we have a meeting of the Fed, or Federal Open Market Committee, which makes the decision. CME has a website. It's called FedWatch Tool. Normally, in my interest rate classes, I do this myself, but since they constructed this, I stopped doing it. It's basically based on, there are futures contracts on Fed funds rates. And based on that, you could guesstimate essentially what percent of the market is betting on a rate increase, decrease, or staying level. Right now, the so-called break-even probability is 99% that it's going to stay the same. Okay, let's look at a year, almost a year ahead. Let's look at the last meeting of this year. That's kind of the attached probable distribution.